On Saturday, August 15, 2026, the US dollar index, or DXY, measures the dollar against 6 major currencies. Right now it has sliced below 99.00, holding at fresh lows after a fourth straight soft US data print. This is not a slow drift. The Wall Street Journal Dollar Index fell 1.19% to 96.39, and the dollar has logged its longest 7-day losing streak since 2020. The immediate trigger is a surprise drop in U.S. retail sales, on top of flat producer prices and cooling inflation. For traders, 99 is more than a number. It signals the market is repricing the entire U.S. interest rate outlook. The sequence matters. We have seen soft CPI inflation, flat PPI, and now an unexpected fall in retail sales. Each release chips away at the idea that the Federal Reserve needs to keep raising rates. When inflation cools and consumers pull back, traders cut their bets on further rate hikes. That lowers the expected return on holding dollars, so money rotates elsewhere. Interestingly, oil's strength pushed U.S. Treasury yields higher on Friday, but that did not rescue the currency. In fact, the dollar fell while yields rose. That divergence tells you this is a growth story, and the market is starting to doubt the strength of the U.S. economy. The impact is already visible across markets. Gold has opened above $4,400 for a fourth consecutive session, though it remains below $4,500. In currencies, US dollar to Swiss franc is stuck in a bearish flag with bulls struggling near 0.8150. US dollar to Canadian dollar is pressing its 200-day moving average, a level bears are targeting. Even the Singapore dollar is consolidating near 1.28 against the US dollar, with OCBC noting upside risks. A weaker dollar typically supports commodities, emerging market currencies, and global exporters. That is an important signal for importers and exporters. But the mixed move in Treasury yields means the rally in gold and foreign currencies is not yet a one-way street. Next week, FOMC minutes will be the key focus. The question is whether they confirm that softer U.S. data has changed the central bank's reaction function. Analysts are cautious about calling this a full dollar bear market. Resilient growth, elevated yields, and geopolitical risks still offer pockets of support. The evidence right now points to a softer dollar, not a structural collapse. If inflation and retail sales continue to surprise on the downside, the next test is whether DXY can hold the mid-98s. A break there would open the door to levels not seen since the early part of this decade. For FX traders, this means the dollar's path depends less on one print and more on the cumulative trend. The dollar's slide is not just a trading story. It tells you the market believes the U.S. economy is losing momentum. That affects import costs, corporate earnings, and the price of gold and oil. For investors, the most important signal is the pattern, for soft prints in a row, and a currency that cannot rally even when yields rise. That divergence is the real warning. Until the data stabilizes, bounces in the dollar index are likely to be sold, and 99 has become the new ceiling to watch. That applies whether you are watching sterling, the euro, or the Japanese yen. If you trade Forex, commodities, or global equities, the message is simple: watch the data, not just the dollar.